They have completely flipped everything that you think is good and bad in crypto. They've completely flipped the script. If you don't know about Berachain, you need to do your research. It has a lot of positives going for it. I'm gonna drive down here to Southern Utah for an event, and I'm listening to all these podcasts, trying to grasp as much information I can about Berachain. I've made a long form video that's being edited right now that's gonna come out, but if you don't know about Berachain, you need to do your research. It sounds like a very complex ecosystem, but it has a lot of positives going for it. Number one, that is a really powerful key indicator, is that it's already accumulated more TVL than Base Arbitrum and many other chains whose market cap is multiples higher and multiple billions. In addition to that, the way they've acquired this is not through airdrop farming, which happens at a lot of chains where the liquidity and the TVL will come onto the chain, and then once the airdrop farming period is announced and the airdrop is farmed, the liquidity rolls off. This happens a lot. In fact, one of the folks that creates a lot of good content in this space, Wajahad Mughal, also known as Raj, he talked about, if you go to DeFi Llama and you look at the list of chains, there's over 300 chains that are listed on DeFi Llama with any significant amount of TVL. And even among those chains, 80% of them are chains with less than $50 million in TVL. And in fact, 70% of them are chains with less than $10 million in TVL. And a lot of that is just static TVL with not a lot of chain activity. In other words, 80% of the chains in the ecosystem, in crypto at large, seem to be what we call ghost chains. And this is a problem that's consistent with the space, and it happens a lot with the predominant consensus mechanism that is out there, which is known as proof of stake. I'm going to talk about why Berachain is different with this proof of liquidity. But if you're enjoying this video so far, you might enjoy some of my other videos. And if you want to take a look at them and have them come up on your feed, if you're watching this on YouTube, take a moment to like this video for a second and subscribe to the channel. It really does help me as a new creator and help broadcast these videos out. But let's talk about proof of liquidity real quick. In proof of stake versus proof of liquidity, consensus mechanisms, there's a key difference. In proof of stake, you can imagine the two different segments of stakeholders. The one segment are the security set of stakeholders. These are the people responsible for the security of the chain. These are typically your validators, miners, what have you. Miners in a proof of work chain, in a proof of stake chain, these will be your validators. So these would be the people, in the case of Ethereum, that are acquiring at least 32 ETH, which is the minimum required to run a validator node and stake your ETH on the Ethereum ecosystem. So they stake that ETH, they get selected to propose blocks, and then as those blocks are proposed, when they are selected, when it's their turn to be selected to propose a block, once the block is selected, they get rewarded in ETH. So you stake ETH, you get rewarded in ETH, and then they probably, most of them, liquidate some of that ETH, keep some of it to run more validator nodes, so on and so forth. So that cycle continues. So in other words, the validators, the chain security audience, is providing capital, earning rewards, and then liquidating that capital in its own ecosystem. It has no relation or incentive to the application layer. It has no interest or direct connection to the actual building and utilization of the chain. This is why you have 80% of the chains in that DeFi Llama list, as Waj talked about, are ghost chains, because the people that are securing the chain have no interest or connection to actually incentivize ongoing long-term utilization of that chain and its ecosystem. And this puts a bit of a disconnect, because the folks that are building applications, they need liquidity. They need people to come onto the chain and utilize applications. It takes time, effort, resources to build applications, to build infrastructure, to build protocols for users to utilize on a chain. And if you're gonna build something and realize that there will be no users, then that's not a good deal, and that deters a lot of builders from coming onto these short-lived chains. Whereas the people with capital are interested in making money, and they typically will just go to the chain security side because there's not enough builders on a chain. So this cycle, this self-fulfilling prophecy to the bottom of the money-making incentive remains on the chain security side on these newer launched proof-of-stake chains, and it can't move to the application layer because the application layer knows, builders know that it's going to be short-lived, so they build short-sighted, short-lived applications and protocols because they know after a few weeks, after a month, this chain is going to become a ghost chain. This is what's happening with most of the proof-of-stake chains out there for the last couple of years. What these guys have done with Berachain is they've flipped that whole mechanism with something called proof of liquidity. And with proof of liquidity, to simply understand that, what they've done is they've taken proof of stake and they've remixed it by solving a few key problems. Number one of those problems is that they've aligned the incentive, or the way that the validators, the security segment of the audience, makes money or can generate money, is now connected to how successful the application and liquidity and utilization ecosystem of the chain is. So in other words, they can't just earn money by securing a chain even though chain is not being used. There's no ecosystem, there's no applications, there's no liquidity being built on that chain. Their success in terms of monetary success is now dependent on how much they facilitate the internal ecosystem of the chain, the application layer, the liquidity layer, the capital efficiency layer, the user and community growth, how much they facilitate that. In the case of Berachain, they've introduced the trifecta of tokens, which you would think would complicate things, and it does, to be fair, to initially understand it. But because of its value add and its benefit, it is well worth the initial complication. The three tokens are Bera, which is the token used for transaction fees on the network, and also the token required to be staked in order to become a validator. The second token is BGT, which stands for Berachain Governance Token, and this token is a soul-bound, non-transferable token. This means that this token cannot be purchased or sold or transferred. The only way this token can be created, one, is through emissions of new blocks being created on the blockchain. And further, the only way this token can be earned, number one, by the validators, is by proposing blocks. So they stake Bera, they get selected to propose blocks, and their reward comes in BGT. BGT being a token that they cannot transfer, trade, or sell. So they're kind of trapped, right? Like they just invested a bunch of money, time, and resources to run a validator node to get selected to propose a block, and they earn reward in a token that is illiquid, that is known as BGT, that cannot be transferred, traded, or sold. The question becomes, what can they do with it, and how does that cycle connect the two sides? Even if they can't sell or transfer the token, they can emit it to something called reward vaults. So they can keep some of it themselves, and they can participate in these reward vaults themselves. And they can also send some of it to these reward vaults, part of the configuration of the node. And when they set up their validator node, they can choose which reward vaults to send it to. What are these reward vaults? This is where it connects the application side. Reward vaults, simply explained, are a structure for the application layer, the liquidity layer, all of the folks that are building stuff on the chain. It's a mechanism for them to track those BGT rewards to these reward vaults so that they can share these BGT emissions with their users, with the application's users. In other words, you now have a mechanism where the validators who can't necessarily transfer the token by sending it to somebody through an address, but they can configure it to go to reward vaults that are attractive to them. How they're attractive, we'll discuss in a second. They can send their tokens to a reward vault that they find attractive, and then those reward vaults can be configured to provide those tokens to the users of the application that has set up this reward vault. This application could be a DEX, it could be a lending and borrowing protocol, it could be anything you can imagine. So far, we've found out that on Berachain, there's a few differences. The validator will stake Bera and they'll earn BGT. They can't transfer, sell this BGT, but they can send it to a reward vault. Reward vaults can be set up by applications that are looking to attract these validators to send their BGT emissions to the reward vault so that they can share with the users. Why would an application like a DEX want to share BGT with its users? And why would users care to get BGT? Let's take an example of a DEX and move along with that. Let's say that it is a DEX, a decentralized exchange that has set up a reward vault. Well, what does a DEX want? It wants users to come and trade on its platform, on its application, on the decentralized exchange. Users will come and trade on the decentralized exchange if there are tokens to trade and token trading experience is good. In order for the token trading experience to be good, there needs to be sufficient liquidity. You see how it's connecting now? How do you attract liquidity? This is where the reward vault comes into play. You can think of many different incentives to attract liquidity as they happen in an inflationary and unsustainable manner on other chains, but that's a topic for a whole another video. Or you can utilize the built-in proof of liquidity protocol and its related infrastructure to attract liquidity. What a DEX does is says, hey, users, come to my decentralized exchange, and when you add liquidity in these token pairs, when you add liquidity in a token pair on a DEX, you receive something called LP tokens, or you can receive, depending on the category, you can receive an NFT. you receive some sort of a representation that indicates that you've added liquidity in a liquidity pool on the DEX, which enables the trading of a token. Those tokens typically represent your share of the overall liquidity that has been added. The DEX may say, hey users, come add liquidity for this token pair on our DEX. And then when you get the LP tokens, you can take your LP tokens and you can deposit them in this reward vault. And when you deposit them in this reward vault, you will then earn the BGT rewards proportional to the amount of LP tokens that you have added in that reward vault compared to the total LP tokens staked in there. The user then now has an interest because they now can get BGT, whereas to get BGT otherwise, at current prices, they would need a minimum of $250,000 Bera, which is about $1.6 million, I believe, roughly. So they would need over $1 million worth of Bera to get BGT. But now, in some cases, they can add a couple $100 worth of liquidity and have a chance of earning BGT. This token that is only able to be earned initially by validators of the chain. Okay, so why would the user care about this BGT? Because then they can take this BGT and they can participate in a couple of things. One, they can take this BGT if they just want to make money. They can take this BGT and they can convert it one way into Bera, which is a liquid token, and they can sell it and they can make money. So they add liquidity and they make money. Or there's a whole flywheel of ecosystems. If you want to think about Berachain, think about flywheel on flywheel on flywheel on flywheel. It's just a bunch of flywheels that never end. So what people have then done is they've taken other things that you can do with BGT. You can take BGT and pair it with other things to earn more yield, but we won't get into that yet. So far, we found that the validator can stake Bera. They earn BGT when they're selected to propose a block. They can choose to send that BGT to a reward vault. Reward vault is a mechanism for an application like a DEX to attract validators in order to send their BGT emissions to the reward vault, but also to attract users to add liquidity or to interact with their platform, take those LP tokens, stake them in the reward vault, and give the users BGT in exchange. Now we know why the user might want to add liquidity on the platform and stake their LP tokens to earn BGT, but why would the validator want to send their BGT emissions to this reward vault? Well, that comes from something called incentives. The DEX can also incentivize the validator with their own protocol token. So for example, the DEX may have a token, call it the DEX token, DEX. They may say, hey, Mr. Validator, I know you have a lot of choices of which application you're going to send your BGT to, but I want you to send your BGT to my reward vault for my application because I'm going to use that fact to attract a lot of users on my application, which is going to help my application become popular and I can, be a successful app in the ecosystem. So in order for you to do that, I'm going to give you, they can set any rate they want, but let's go with the example. For every BGT token you give me, I'm going to give you 10 DEX tokens. So the ratio is 1 to 10. So the validator like, okay, that's pretty cool. Like the other reward vault is only giving me 2 of their application token for 1 BGT token. And this other application was only giving 5 of their token for each BGT token. I like this reward vault. I'm going to send most of my emissions to this reward vault. So now you know how validators are choosing which reward vaults to send the BGT to, because they can earn incentives, which are the platform or the applications token that is setting up the reward vault in exchange for the BGT. Then the application uses that BGT that is in the reward vault to incentivize users to participate in the application. So what has happened is, where previously the validators of a chain were completely disconnected, could not care less what happens to the chain, which is why you have so many ghost chains. Chains come out, become popular, liquidity goes away. The people validating the chain are still making money and dumping the token on the market, but there's nobody building anything, nobody using the chain. Now the validators cannot make money unless they participate in supporting the application protocol. So how did the validator make money in this case? The incentive token that the validator got is the liquid token for them. So they may make money in multiple tokens or multiple ecosystem projects. And then further, there's another flywheel where they can incentivize, they can take some of those incentives of the DEX token in this example, and they can give it to people that are boosting their validator node. So users can actually take the BGT that they're earning from this DEX. Let's say that I'm a person that had added a couple $100 worth of liquidity and I'm earning BGT in this case. Of course, one of the ways I talked about, I can take that BGT and turn it into Bera, but I can also take this BGT and go to that validator and I can boost that validator's node so that they earn more BGT, which would mean that they would send more BGT to the reward vault, which would mean I would get more BGT, which would mean I can then add more BGT to their route. So then another flywheel. It's genuinely and very fairly a bit complex to understand at first, and my friend Barry Bendito turned me on to this. He's been in the space for a long time, but it is well worth it. I think it's going to revolutionize DeFi. It already has started to, and you don't want to be late to finding this out. I'll also be trying to break down a little bit of what exactly is Berachain, what exactly is proof of liquidity, helping you understand the mystery that is this chain. And the technology is not even the most exciting part, even though the technology and the economic innovations are very, very, very exciting and very impressive. The more exciting part is the culture. The culture undoubtedly is one of the most fun, engaging, and relatable cultures that I have found in crypto. The chain is called Berachain, for God's sakes. Like, being bearish in crypto is obviously not a good thing. But this is a chain that has fudded itself to success. If you go to Berachain's site, I believe it's berachain.com, you can Google it. It loads on the bottom. It loads the bottom part of the site first. They have completely flipped everything that you think is good and bad in crypto. They've completely flipped the script. They love being silly. They say instead of GM, they say BM for bear morning. They like to say ooga booga. I'm learning these things and I'm gonna take you along for the ride so you can learn them along the way as well. And maybe see some great scenery in Utah. So hopefully this helped explain a little bit of what Berachain is and what I'm bullish about. I'm learning a lot. I'm listening to podcasts. I'm diving into the white paper. I'm getting all of the technical information, and I'll be sharing it with you guys and breaking it down and making it simple and easy to understand as we go along with this journey. So thank you for watching this video, and I'll see you in the next one.